But this video is going to talk about efficiency. It's going to use the concepts of producer and consumer surplus, or what we'll call total surplus, to then talk about efficiency. So previous video covered both what consumer surplus and producer surplus are individually. And one way to think about it is total surplus represents gains from trade. The surplus arises when we produce goods and services and the willingness to pay for that good exceeds the willingness to supply. So when we look here, we've got the demand curve. We now know this can be thought of as this is the willingness to pay, consumers' willingness to pay for the good. The height of the demand curve measures the dollar value of the good to consumers if they're able to consume it. The height of the supply curve shows us the willingness to supply for producers. And if we think if this good has to be produced, then the willingness to supply is really sort of a cost, because it would be the amount that a producer would need to receive to be willing to go ahead and produce the good. And so if you had to make a chair or make a pencil or any kind of a product to sell, well, you need to be able to pay for all the inputs and the labor that you need to produce this good. And so the willingness to supply is going to be related to the cost of producing a good. So we get surplus when we produce a good and it's worth more than the resources that it costs to produce the good. So when we look at the first units of this good here on a supply and demand diagram, we see the height of this demand curve is taller than this supply curve. So the willingness to pay for these units are up here. The willingness to supply, or the cost of supplying them, are down here. So as each of these units get produced, we're getting willingness to pay that exceeds the willingness to supply. That's going to end up being consumer and producer surplus. So when we think about efficiency and we have these gains from trade, what we can ask is what quantity of this good would give us the biggest gains from trade, maximize the gains from trade? Well, if we're getting consumer and producer surplus on any unit, when the demand curve is above the supply curve, then we'd have to say, well, we want to produce goods. As long as we're producing goods and the demand curve is above the supply curve, we must be adding to the total surplus. The total surplus must be going up. Well, when we get over here, now, when we get far enough on this diagram, the demand curve is below the supply curve. And the demand curve is below the supply curve. If we produce a unit of this good over here, the value of the good to the consumer is given by the height of the demand curve, that's here. But the value of the resources that we use to produce that are given by the height of the supply curve. And up here we see that the supply curve is taller than the demand curve. If we produce units in this region, that total surplus will be going down. It will be going down because we are, in fact, taking valuable resources, and the value of the resources we need to use to produce this good are given up here by the supply curve, and we're using them to produce units of this good that are worth less. Not worthless, but worth less than the resources that we used to produce the good. So here, if we produced units of the good here where the demand curve is below or not as tall as the supply curve, we would be getting a negative surplus. And as we add a negative surplus to the total surplus has to be going down. If we want to maximize the total surplus, we want to continue to produce the good as long as production of that good is generating a positive surplus, as long as the willingness to pay is greater than the willingness to supply. So we want to produce these units here. We don't want to produce any of the units here, so we would actually want to stop here where the demand curve is the same height as the supply curve. So we would stop here, and max the total surplus is going to be maximized here at this quantity. And we'll put a little star by it. It's just a convention in economics. A lot of times we'll put a star by any value, by any variable when we're referring to the efficient quantity. So here's the efficient quantity of this good, and this is where the gains from trade would be maximized. Now, we also know that this would happen to be the equilibrium quantity, because the equilibrium equilibrium price would be the price at which quantity demanded equals quantity supplied, and that's it. That's this quantity Q star. So this would also be the equilibrium price. And so what we would see here is that we would have some consumer surplus in equilibrium. That's the consumer surplus. And then we're going to have some producer surplus as well. And this is what the diagram would look like at equilibrium. And this would be how we would break down the efficient quantity of the good and the breakdown of it into producer and consumer surplus. And so it's important to point here. What we've seen is that the equilibrium quantity also happens to be the quantity that maximizes the total surplus for this good. And so that's why we would say in this case that equilibrium in the market turns out to be efficient. Now there's a couple of things to note here. First off, equilibrium, we described the process to get to equilibrium back in chapter 3. We said consumers are trying to shop around for the best deal, and they won't buy goods when the price they have to pay is greater than the value of the good to them. So they're trying to make themselves better off. Suppliers are trying to make themselves better off. They're trying to produce goods and sell them for a profit. Consumers and producers are each looking out for their own interest, and that's how we get to equilibrium. If the price is too low, some consumers can't get the good, there'll be a shortage. Some consumers can't get the good, we'll bid up the price. And sellers would say, like, oh, we can realize we can sell what we're producing for more. If the price is too high, there's a surplus. Whoever's producing the good can't sell it. They're losing money because they're using resources to produce something, and then they can't sell it, and so they don't want to continue to lose money. So consumers and producers, in trying to make themselves better off, that was the forces really in chapter 3 that we described that led us to equilibrium. So consumers were trying to make themselves better off, producers were trying to make themselves better off. They get us to equilibrium, but it also turns out to be the case that equilibrium is efficient. In other words, if we wanted to try to maximize the total surplus, well, that would be the quantity we need to have. Another thing to talk about is that when we talk about this surplus really are gains from trade. When we think about it in an equilibrium here, we can see that both consumers and producers are better off because this good gets produced and consumed than they would have been otherwise. On each of these units here, consumers are getting a consumer surplus. They're getting units that are worth this amount to them. They're only having to pay the equilibrium price here. And producers are getting a price that is greater than their willingness to supply for these units of the good. They're both gaining. There is an important point to see that trade in markets like this are making both parties better off. And this is how essentially we measure efficiency in our economy. So we gave one way to see it back in the chapter 2 with the production possibilities frontier, talking about being on the frontier versus inside the frontier. Here we see another way of thinking about trying to get a quantity in the market that's going to maximize the total surplus. Now, there's one thing to remember about efficiency, the way we're defining it. We're defining efficiency based on really the demand curve. The demand curve is the way that we're valuing the good. And the demand curve is people's willingness to pay for the good. When we define quantity demand, it is the quantity that people were willing and able to pay for. Well, demand involves willingness and ability to pay. The ability to pay means that it is related to the amount of money that people have. You can't pay more to buy a good than the money that you happen to have in your bank account or have access to. You can't purchase some good for a price that exceeds the amount of money that you have available. Demand curves reflect the amount of money that people have. So demand curves do reflect the distribution of income or wealth in society. People can't bid for goods. They don't have a demand for the goods if they don't have some money to trade with. So economists focus on efficiency, but some people would want to raise claims about equity or the distribution of income in society. One thing to remember here is that our demand curves, our market demand curves, are based on the distribution of income in society. So we're getting efficiency here, and we're talking about what's going to make the economy efficient. that is given the distribution of income in society. So that is perhaps a limitation of efficiency as a normative concept. Efficiency is a normative concept. Equilibrium, if you want to think about it, is a positive concept. Equilibrium is telling us what is going to happen in the market. Efficiency, or what is also called welfare economics, evaluates the question of whether that performance is good or bad. And we see here's a case where, the market equilibrium turns out to be efficient, and it does so by maximizing the consumer and producer surplus.